Here's where we stand on Sunday the 23rd of August, 2026. Gold has just powered through the $4,600 level, reaching an intraday high of $4,632.14 on Friday, and closing the week with a gain of more than 5.6%. This is the third consecutive weekly gain, and it marks the highest price for gold in 3 months. Now, a 5.6% weekly move might not sound enormous, but for a market as deep as gold, that is a serious repricing. It tells you that something fundamental has shifted in how investors view risk. At the heart of this is a classic flight to safety. When geopolitical tensions flare, capital moves out of shares and into assets that hold value in a crisis, and gold is the oldest and most trusted of those. But what makes this rally unusual is that it is happening while the US economy is actually showing strength, which should normally push gold down. So in the next few minutes, I will break down exactly why gold is rising, what it says about the global mood right now, and whether this move has legs. The past 7 days have been extraordinary. On the 16th of August, gold was trading around $4,376.97. By the 21st, it had climbed to $4,607.35, a jump of over $230 in less than a week. The trigger most commonly cited is the escalation of tensions in the Middle East, which has increased the so-called risk premium, the extra price investors are willing to pay for insurance against a sudden shock. But this is not just a Middle East story. The US dollar has been flat near 98.82 on the dollar index, which means the gold rally is not simply a currency effect. American 10-year Treasury yields actually rose to 4.75%, which would normally make gold less attractive because bonds pay income. The fact that gold rose anyway tells us that fear, not yield, is driving the bus. We also saw a notable shift in Federal Reserve expectations. Money markets now price a 60% chance the Fed holds rates unchanged in September, down from 68% a day earlier, while the odds of a 25 basis point hike have risen to around 40%. In other words, investors are becoming slightly more nervous that the Fed might tighten, yet gold still climbed. That disconnect is crucial. Here is the puzzle. S&P Global's data on Friday showed the U.S. services sector expanded at its fastest pace since December 2024, with the PMI hitting 56.8, well above forecasts of 54. Chris Williamson, the chief business economist at S&P Global, said U.S. output is growing at its fastest rate in over 4 years. Normally, when an economy is booming, gold tends to struggle. Money rotates into shares and corporate bonds, and the opportunity cost of holding a non-yielding asset like gold rises. But this time, gold is ignoring that playbook. Why? Because the strong services data also feeds another concern. If the economy is this hot, the Federal Reserve may feel pressured to keep rates higher for longer, which could slow growth later and widen the U.S. budget deficit. Meanwhile, manufacturing slowed to a 5-month low at 53.2, showing the recovery is uneven. So investors are hedging against a potential policy mistake. The Fed might over-tighten into a slowdown, and gold is the hedge. This is the contradiction of August 2026. Good news for the economy is being read as bad news for risk assets, and gold is benefiting from both sides of that trade. Beyond geopolitics, there is a deeper, slower-moving force at work: U.S. debt sustainability. On the 22nd of August, the US Treasury announced it would double its buyback program for longer-dated treasuries. In plain English, the US government is buying back its own bonds, the ones that mature years from now. The official goal is to support the bond market, but the signal it sends is that Washington is worried about how much debt it has to sell. Treasury Secretary Scott Bessent said the administration's next strategy is a stronger focus on fiscal consolidation, and that buybacks could be expanded further. For gold, this is rocket fuel. If investors believe the US will struggle to service its debt without inflating it away or eroding the dollar's value, gold becomes the ultimate store of wealth. That is why, even as Treasury yields rose, gold powered higher. The market is not just pricing a geopolitical event, it is pricing a slow erosion of confidence in paper assets. This is the silent driver that could keep a floor under gold long after the Middle East headlines fade. So what does this mean for you, the viewer, on this Sunday? If you already own gold, whether through physical coins, an ETF, or a mining stock, you have just seen the value of that holding jump by more than 5% in a week. But before you get excited, remember that gold pays no interest. At a time when US 10-year yields are at 4.75%, holding gold means giving up that income for the sake of safety. For savers in the UK, the picture is even sharper. If your savings account is paying, say, 3 to 4%, gold's rally might tempt you to switch into the metal, but you must weigh the risk of a sharp pullback after such a fast move. Central banks are also sending a signal. Poland's central bank bought only 7.8 metric tons in July, a slowdown from previous months. That suggests official buyers are becoming more cautious at these elevated prices. For everyday investors, the key lesson is not to chase a 5.6% weekly spike blindly. Instead, think about gold as portfolio insurance, not a get-rich-quick trade. A small allocation can protect you, but a large speculative bet could hurt if the geopolitical temperature suddenly cools. Where does gold go from here? The near-term trajectory hinges on three things. First, the Middle East. If tensions escalate further, expect gold to test the Friday high of $4,632 and possibly push toward $4,700. If there is a de-escalation or a ceasefire, gold could quickly give back 2 to 3% as the risk premium unwinds. Second, the Federal Reserve's September meeting. Right now, markets see a 60% chance of a hold and a 40% chance of a 25 basis point hike. If the Fed hikes, gold may dip in the short term because higher rates raise the opportunity cost of holding gold. But if the hike is seen as a policy mistake that risks recession, gold could actually rally on the back of a flight to safety. Third, US Treasury buybacks. Any further expansion of that program could push long-term yields down, which would support gold, but it could also stoke inflation fears, which is another tailwind. Technically, $4,600 is now the battleground. A daily close above $4,632 would signal continuation, while a close back below $4,600 could trigger profit-taking. My base case for the coming week is choppy, range-bound trade between $4,550 and $4,680, with headlines driving sharp intraday swings. To wrap up, gold's surge past $4,600 is not just a one-day fear spike, it is a three-layer story. Layer 1 is the Middle East risk premium, the immediate spark. Layer 2 is the US economic paradox, strong services but a slowing manufacturing sector, which makes the Fed's job harder. Layer 3, and perhaps the most important for the long term, is the growing concern over US debt sustainability, highlighted by the Treasury's expanded buyback program. When a government has to buy back its own long-term bonds, it raises questions about who will ultimately fund the deficit and at what cost. Gold is the market's answer to that question. For you, the takeaway is clear: watch the $4,600 level, watch the Federal Reserve's September decision, and most of all, watch whether this rally is driven by fear alone or by a deeper loss of confidence in paper currencies. If it is the latter, $4,600 may be just the beginning. But if the Middle East calms and the Fed signals resolve, a correction would be healthy and probably swift. Either way, this is a market you cannot afford to ignore.